Good morning, Southeast Missouri, and wherever you may be listening. This is the Retirement Playbook brought to you by Innovative Financial Solutions. We are the retirement people, and we're here with you every Saturday morning, bringing you some great information to help you in your retirement. And as always, I'm joined by Mr. Tony Shore on the video, on the podcast now, on YouTube. Tony Shore.
All right. I think some people are creating a meme where they take my hair and put it on you to make one really good-looking host. To make one really good-looking host. With your face and my hair, come on.
You are a funny guy.
Hey, we're trying to compete with the Kelsey brothers, right?
I know. The radio listeners are going, what in the heck are they talking about right now?
Right. You can look at the YouTube video of our podcast and you'll see what we're talking about. But Brock, I'm excited to be here. And I know that last week or the week before you held up a Chiefs mug you were drinking coffee out of. And I said, oh, I see you're a Taylor Swift fan. And you did not like that. So all your friends at Gradient listened to the show at the Gradient marketing team, GPS, and they sent you a mug. What did that mug say?
It had a jersey in the middle of it, number 87, which is Travis Kelsey, the tight end, the superior tight end for the Kansas City Chiefs.
Yeah.
And then it had Taylor Swift's boyfriend written all around it. That's where I draw the line, Tony Shore. I appreciate the thought by all the gals there, but not digging it, ladies. Not digging it.
You're not a Swiftie.
I'm not a Swiftie.
Well, that's true, but you are a fan of the Kelsey brothers, right?
I am. Yes, I do. I like their little podcast they do.
Their podcast is awesome.
Yeah, I don't get to listen to it a lot just because busy, but I do get clips of it here and there, and they do a good job. Those guys are entertaining. The Kelsey Bowl from the Super Bowl last year.
Yeah.
The whole going this year, actually this week, this Monday night, they're playing each other again. I don't know if you knew that. Yeah, they're not calling it the Kelsey Bowl, though. They're calling it the family reunion or something like that. I don't know. But
that'll be
anyway.
Fun.
Yeah, it'll be a lot of fun. And speaking of fun, we had a couple really good wins this past weekend with our local teams. Jackson Indians beating Seckman, beating the tar out of them. Actually, that was a good beating, good game. And then Cape Central.
I'd seen that. I didn't see that game.
Yeah, and then Cape Central won their district and won their game.
Oh wow,
in Farmington. So yeah, congrats to all those players and families and coaches and all that. So. Anyway, on to bigger games. Good luck this weekend, too, to those teams. CBC, Jackson, and then Cape Central travels up to Eureka. So that's going to be good. And actually, by the time this airs, we're going to know the result of that. So good luck,
That's
guys.
good. Yeah.
Also, hey, listen, this is the retirement playbook, right? Aren't we going to talk about retirement today? I would think.
And finances, right?
And finances. So, but before we get started, listen, our website, theinnovativeteam.com. theinnovativeteam.com has got some great information on it. You can get started today with getting a roadmap, getting a game plan, getting a playbook for your own retirement. Check it out. It's theinnovativeteam.com. You can download past shows. You can order my book. You can do a lot of things on that website. Lots of great information. But that information is only as good as what you do with it. So put it to practice. Call us. We'll get a plan together for you today. 573-332-7855, or look us up again on that web address is theinnovativeteam.com.
All right.
Yeah. Okay, Tony, you ready to kind of get started? I wanted to kick the show off with something specific, dealing with taxes, dealing with people that live in Missouri. And then we're going to talk a little bit more about taxes and some year-end planning that people can do. I know we kind of hit on it a couple shows ago, but let's dive in a little bit deeper today. Give you some tips out there, folks. Who doesn't want to save money on taxes, right? And so that's what we're going to start with. And actually, in 2024, starting next year, okay, this is not going to apply this year, but starting next year, Missouri, this was a few months ago, actually, they passed this, where they're not going to charge state income taxes on your Social Security benefit. So in prior years, right, age 62 or older did not have, unless you fell in these income gaps, where it wasn't taxable, obviously. But if you were over those taxable limits, your Social Security was not only taxed at the federal level, but also at the state level. Now, remember, 85% of that benefit is tax free, or excuse me, 15% of your benefit is tax free. So 85% of your benefit was subject to federal taxes and Missouri taxes. Okay.
Wow.
Starting in 2024, 4.95%, by the way, is how much the percentage was, is that as far as how much of your benefit, and then, or whatever your benefit is, multiplied by 4.95, that was your Missouri tax bill on those benefits. Again, starting next year, that goes away, which is a huge savings for folks, right? We see that, inflation is still pretty high. Everything costs more. And really, when Governor Parsons passed this law, that was his intention, is to say, hey, we've got a little bit of a surplus here with our budget. Thank goodness, right? We have fiscally responsible government right now, and in Missouri. And so now he's saying, okay, these older people are subject to all these increases. You're talking about not only your groceries and your gas, but your real estate, because your real estate value's gone up. And so now you're paying more property taxes. There's a lot of things that are just going up. And when you're on a fixed budget, it's hard. So they passed this law back in July, actually, it came effective. And so that's a great savings.
Oh, that's the best news ever. And I think that's really good. I don't think Social Security should be taxed at all. But unfortunately, it is. It wasn't initially, and then it was taxed 25%, then 50%, then 85%. And
right,
they'll probably raise it to 100% taxable at some point. But I'm glad that Missouri is a state. There were 11 states that taxed Social Security.
right,
and Missouri was one of them. But now, starting next year, they won't be. So there will only be 10. And that number has gone down, not up, which is a good sign.
Yeah, right? It is a good sign. And I also think it's a sign. Now, here I'm going to get a little bit on my soapbox here. I think it's a little bit of a sign that says, hey, why don't you let the states run a few more things? It seems like they do a better job than the federal government. So,
yeah, at least in this area, they're doing a better job. Yes.
Again, kind of get on the soapbox a little bit there, but might want to take a little lesson there. So, speaking of taxes on your Social Security benefit, let's get into that a little bit here.
Okay.
In that, again, 85% of your benefit is taxable unless you have provisional income. That's combined income, which is basically half of your Social Security benefit plus all of your other income. Okay. That number that is called your provisional income, half your Social Security benefit plus all of your other income. If it's over $25,000 for a single person, then 85% of your benefit will be taxable. If it's over $32,000 for a married couple, then your 85% of your benefit will be taxable.
And those numbers are low. So pretty much everybody, hopefully, I mean, in one way, hopefully, in another way, not. Hopefully, you're making more than that. But unfortunately, that means your Social Security is taxed, right?
It does. And so, if there are some planning tips.
So, Brock, you're going to need to make less next year.
Listen, tax planning is definitely very, very important. You have to do it to get the most successful, most rewarding retirement.
You got to do the math, number one, and you got to work with a financial professional like yourself, right?
Agreed. But there are some instances where tax planning has superseded priority, and maybe it probably shouldn't. Like, it's definitely should be a part of your plan.
Sure.
But let's not drive every decision that you make. Now, going back to federal taxes. So think about this, though, Tony. If you said, okay, half of my Social Security benefit plus my other income. Now, unless that income comes from what? And I know you know what I'm going to say. Roth IRA distributions.
Yep.
Right? Roth IRA distributions do not count towards how much of your Social Security benefit will be taxable, i.e. your provisional income.
And some insurance payouts too, right?
Exactly. And so you've heard me talk about this as well. So what else does? And that is payments from your cash value life insurance policies, whether Now you have to structure this correctly. Like you just can't just take a withdrawal and go, okay, I'm good. No, are we taking basis? Are we doing a loan? What are we doing? Okay, because if you take taxable money out of it, then it doesn't help you with this. Okay, so again, you have to structure this correctly. But think about this. So if you said, okay, my provisional income, half of my Social Security benefit plus my other income. And what if your other income was coming from both of those sources, though? What does that mean? That means you could potentially have a tax-free retirement. None of your Social Security benefits going to be taxable because your provisional income is low enough. And well, your Social Security, half of it, right? And then if that's the only thing is half of your Social Security that they're going to calculate what your provisional income is, holy cow.
Yeah.
I mean, now we're talking some serious benefit here. And that's why, that's why I am a huge proponent of the Roth 401k. If you own your own business, okay, and you think, okay, well, I'm just going to do the IRA. Okay, that's fine. Okay, but when you get to a certain level and you say, okay, I want to put more than $6,500 away, you can do that by opening a solo K. Super easy, not expensive. And now we can do over $30,000 per year. Of course, if you've got the means to save that much. These are huge benefits that if you're not taking advantage of doing this. Now, what's the downside? What's the cost? Well, you're paying taxes. You have to fund the Roth with after-tax money. So that money is being taxed right now. But to have that compound and then be able to take out tax-free withdrawals, man, oh man, that is a huge
and to be able to avoid the tax on 85% of your Social Security and retirement is the benefit too that you
100%, Tony. Yeah. Yes, great point.
Huge.
Yeah, 100%. And so that, and then again, you can do some other things that will help you create tax-free income. That's the ultimate. I mean, it doesn't get any better than that. Now, I'm going to say this, and people know this, but rules change all the time.
They do.
Right? Now, people have said, well, the government's going to come back on all these Roths. They're going to make it taxable. It's impossible, folks. It's not impossible, I guess, but that would be very unlikely for them to do that because it was funded with after-tax dollars.
You would pay taxes. Money has already been taxed.
Yeah. So anyway, huge tax strategies to be put into place. And obviously, Tony, like everything, really, when it comes to savings, the earlier you do this, the earlier you plan, the better.
Yeah.
Now, when you get a little bit older and you're getting closer to retirement, there are still some things you can do. One of the things that we've implemented in strategies is Roth conversions. You have to be careful. You have to do a really good analysis on that, right? Because now we're talking larger chunks of money being taxed and causing all of your other income to be taxed at higher rates in a 1 or 2 or 3 or even 5-year time span. Okay. Now, if you can convert some of your traditional IRAs and 401ks over to the Roth option and stay within the, say, for example, 22% tax bracket, then it might be a good idea. Okay, I'm going to pay 22% in taxes to have tax-free income for the rest of my life. So again, it's not always the most, beneficial thing for you to do, but you've got to do the analysis. You've got to work with your advisor, and you've got to work with a tax advisor as well, your accountant, in other words, to make sure that, okay, we've given you this information, but let's confirm it and make sure everything will work out the way we believe that it will.
Yeah.
Okay. It's always a good idea to confirm those plans, right, Tony?
It is always a good idea. And you have to be working with a financial professional, somebody like yourself, who is going to be able to help you avoid the pitfalls that can be costly. And you never want to make any of these moves or do a Roth conversion without working with a trusted independent financial professional like yourself.
Correct.
Yeah.
And, there are some other things you could do, right? If you said, okay, we normally like to give to charitable causes, right?
Okay.
But our income is low enough and we don't have the deductions as much to itemize. And so you take the standard deduction, right? The roughly $6,000 standard deduction. Well, what if we said, hey, let's convert maybe 50 or $100,000 of your IRA, and then we can offset that by contributing to what we call a donor advised fund, and it will offset some or all of those taxes that you converted the Roth with. So that might be a strategy to consider. But again, that takes a bunch of after tax dollars to put in to get that deduction for putting the money in the donor advised fund. So again, everybody's situation is different, Tony. You know this. Everything's customized to what we do. We talk about different strategies on the show, but it may not work for you. And so you have to give us a call to get a true customized plan. Give us a call, 573-332-7855. Or again, that web address is theinnovativeteam.com.
I like it. And on the website, Brock, I want to point out to the listeners that they should head to the show page, and there they can listen to this episode. They can listen to past episodes. They can subscribe to the show on YouTube, Spotify, Apple Podcasts, Google Podcasts, Amazon Music, all the major podcasting sites. So the show is there, and it's just they can look for the topic they're interested in. We've done shows on Roth conversions before where we hone in on that. We've done shows on year-end planning. All of these topics, Social Security maximization, the markets, what's going on there, risk tolerance and risk management. So it's really important to stay on top of these things. And like you said earlier, there's always changes, especially with the tax laws, especially with the rules surrounding taxes. And everything ties into taxes. The money you get from stocks, Social Security, everything we bring up, all your investments, everything has tax implications, right? Unfortunately.
So it does, but Tony, not even when to consider while you're living and the income taxes that you're paying. But what about passing the money that you've worked so hard for to create income for the rest of your life? Whatever is left, we need to make sure that it passes on to your beneficiaries in the most tax efficient manner.
Yeah.
So there's some things to be done there. We do step up and basis calculations and then offsets with that every single year with multiple clients.
Right, because you don't want to leave your loved ones, your kids, your grandkids with a tax burden. So and that can be a costly mistake that people make. So you're saying if they meet with you, you can come up with a plan that will help and work alongside estate planners to make sure that it's tax efficient for them.
100%. Now, Tony, look, if you've got a pretty simple situation and you're older, you're 75, you're 80, 85, and you've got these IRAs and you're taking your minimum distributions, and then it's going to go on to your beneficiaries, and they can do either the 10-year payout upon your death. Again, there may be just, okay, yeah, I've had this money, it's been deferred, I've been paying taxes on my withdrawals, but it's just going to go to you and it's going to be taxable. Okay. I mean, you're still free money they didn't get, but if there's some planning that can be done to reduce that and or not pay it at all, why wouldn't you do that? So to your point, sometimes you're just going to pay taxes on the money that you inherited. But if we can, again, avoid that, then, that's always better. So, anyway. Okay, so speaking of year end, speaking of taxes, if you have not taken let's back up. If you're 73 years old, or if you turn 73 in 2023, Tony, you need to make sure that your required minimum distribution is going to be taken out of your IRA by the end of the year. Okay. And if you don't, it's a big penalty. It's not as big as it used to be, but it's still, why pay a penalty if you don't have to? It's, November, the middle of November. Okay, it's November 18th. So you need to make sure that by the end of the year, and by the way, I know, for example, like Charles Schwab, that's who we use as our custodian. They have purchased or merged with TD Ameritrade Institutional, okay? And it has created some clogs in the system. In other words, there's so much going on, and there's so many advisors and so many clients that need things. My point is that you don't want to wait until December 20th or later to take that required minimum distribution, folks. If you know that you have to take your required minimum by the end of the year, do it now. Okay. And it's like everything in this country. It feels like everything is a little bit slower than it used to be or slower than it needs to be. Again, you don't want to be subject to getting caught into, service delays and those kinds of things. Get it done. Required minimum distribution. Remember, your your required minimum distribution for this year is going to be based off of the entire balance of all of the IRAs that you own. Okay. So, for example, if you've got 5 different IRAs, in other words, you got one at the bank, you've got one in brokerage, you got one in annuity or whatever. Okay. The way it calculates is you add up all of your IRA balances. Okay. And then you have a divisor. 26.9, for example, is the one at 73. So you just have that balance from 1231, you divide it by that number, and there you go. That's how much you have to take out. A lot of people think it's a percentage, Tony.
But your clients don't need to worry about that because you help them with this. And,
sure. Yeah. I mean, if you work with an advisor, you shouldn't have to worry about any of this stuff. Just, maybe just make sure that you've taken it, or maybe remind your advisor that, hey, I didn't take it and I'm 73. Again, you shouldn't have to do that either.
Right.
If you're with Innovative Financial Solutions, you wouldn't have to do that.
Right. Exactly.
But my point is just to give you an idea of how much it needs to be. And then for people that will be 73 next year, that's kind of a nice little nugget of information there to know that around about, what you would have to approximately what you would have to take out. Speaking of next year, again, we're at the year end here. We're talking about year end planning. Remember, the amount that you can contribute to your retirement accounts goes up every year.
Yeah.
It's kind of the time to be thinking about increasing your contribution for 2024. The cool thing about a lot of the retirement plans nowadays, Tony, at work, the workplace, 401ks, for example, 403bs, is that most of them have adopted kind of an automatic increase built into their system. Now, not all companies agree to do that or offer that to their employees. And if they do, some employees can just turn it down. They don't want to increase their contribution every year. I think it's a great idea. All right.
Yeah, you really should be because of inflation and just you got to keep funding it and make sure you're putting more in and dollar cost averaging your way in over time, right?
For sure. And so if you increase that by just 1%, I promise you're not going to miss 1%. Okay.
Right. Or probably even 2 or 3.
Probably so. But I promise you won't miss 1%. Okay. So if you have that opportunity in your workplace retirement plan, check it out. Maybe subscribe to that and hit that enroll button, and that automatic increase, that 1% increase every year is a great idea to be able to do that. The other part of that is if you're in there and you're looking around at your 401k, just seeing how it did this year and kind of looking at everything and going to maybe possibly enroll into that automatic increase plan. What I would also encourage you to do is to look at your options. Do you have an after-tax Roth option in your 401k? And the second question is, are you taking advantage of that? Because remember, the match or the contribution that goes in from your employer will be taxable to you in retirement. There's no if and or way. Well, actually, there are some options now that companies can match after tax as well for the employee. But how do you know what your plan does unless you get in and do some research?
Yeah.
Okay? Make sure that you're in the right plan. And this is the advantage, again, Tony, kind of going back to what you said, of working with an advisor.
Yes, that's a must. And we're out of time for today's show. So let our listeners know how they can get a hold of you, Brock.
Yeah, give us a call to Innovative Financial Solutions. We are the Retirement People, 573-332-7855, or look us up on the web at theinnovativeteam.com.
All right. Well, Brock, great show today. Listeners, thanks for tuning in. That does it for today's episode of the Retirement Playbook with our host extraordinaire, Brock Alspaugh.